Hi everyone. Today we have Namita, who's built a real category of one by working in a wide range of operational roles, working with institution building, and now setting up her own fund. So today she's going to walk us through her first 100 days, along with leaving us with clear mental models about her journey, what was good, what was bad, and then after about 30 minutes, we're going to just take a status check, see if everything's been covered and there will be about 20-25 minutes where you can ask anything. This is again like this session is entirely for you. Please feel free to ask Namita anything. Really grateful for your time, Namita. Thanks so much. Really appreciate you being here with us. Thanks. Over to you.
Thank you, everyone, and it's really my pleasure to be talking to a bunch of super talented and motivated women. I read all of your profile, and it's great to see what you have already done and what you are looking to do. So, thank you for giving me the opportunity to share my own experiences, and really looking forward to this conversation. Really, while I share my experiences from the last 1 year or so of setting up the fund. But before I get into that, maybe just a little bit of my own background. Um, and how I even got into investing, right? So this is not something that I had imagined to be doing maybe 10 years ago. Really, when I was graduating from college, the thing that I really wanted to solve was access to opportunities for people. And in fact, I let go of my job in technology companies and PhD offer to really start tinkering with the education sector. This was 2007, and there was not such clear education industry at that point in times. And but I was lucky to become part of National Knowledge Commission, a public policy think tank that time under the PMO, Prime Minister's office. And I really took up that offer because it gave me an opportunity to understand education 101, look at it from a macro perspective, understand the problems and perhaps some solutions. It was also becoming clearer to me that I didn't necessarily see myself becoming a policymaker myself to solve that problem. So I think that was also helpful, while I completely understood the importance of the policy and the role the policymakers play. Um, Long story short, I went to do business school in Bay Area. I then again, as I was graduating, I got pulled back into education, and in Silicon Valley is when technology really happened to me, and I started tinkering with technology in education. Did a bunch of roles, came back to India, uh, committed to work in education sector for 10 years and not thinking anything else. And the functions for me were going to evolve. So it happened very much that ways. I joined a philanthropic foundation in 2012 and was part of the founding team to set up that foundation. It's now one of the most known foundations in country in education. It's called Central Square Foundation. My role, besides being a founding member, was also to look at technology in education and really look at what apps we can build for students and teachers. What that experience gave me was real insight into what is happening on the ground. I probably visited some 200 schools um, across the country and across the regions, and really understood all the different stakeholders. And the reason I'm telling you all of this is because when I after doing this for 5 years, when I just paused and really thought about like what I really enjoy and what I really wanted to do for the next 5 years of my life, I realized that I was really enjoying working at the sector level in education, which means that I was looking at uh, different pain points in education while my lens was technology, but I was incubating several entrepreneurs and working with those entrepreneurs, and I really enjoyed that role. And second was really that working at the sector level and really thinking about different theses. And then when I stepped back, I realized that this skill set and my interest I could take it to investing, really, right? Because that is what investors also do. That took me to impact investing work at Omidyar Network India, where I continue to play played the role of supporting the nonprofits and policy making, but also started investing in for-profit companies. When I started doing investing, I was able to find some companies which are now become stellar and have also given great exit opportunities to the fund. Really did well thanks to all my mentors in investing, my mentors at work at Omidyar Network, and plus the opportunity I got. But really that became my launch pad to really get into investing. So I did that for 4 years. And the unique advantage I felt I was bringing was really the deep experience I was bringing in education, what I was describing to you a minute ago, which was really having those insights in terms of what the on-ground realities were, what works, what doesn't work, what does it mean to scale learning with the use of technology, and where does technology not help, right? So I had a lot more deeper insight, even from an investing lens when I came to investing, and I used that to do my investing, and I attribute the success of my investing so far to that. In 2020 is, I think, I guess the COVID also helped you, the lockdown also helped you to kind of think about, reflect on what you really wanted to do with the rest of your life. And I think there was always this idea of setting up something of my own. The choices were whether I wanted to set up a company or whether I wanted to set up a fund. And because I continue to enjoy working with the entrepreneurs and helping them build organizations, the choice for me was naturally going to be setting up a fund. And that led me to really set up the fund along with like-minded people. The story behind how Enzia was set up actually started with my friend from college who I know for the last 20 years. She actually, in 2018, her name is Jayashree. She actually had started tinkering with the idea of setting up a fund focused on healthcare at that time, and was looking for partners to really be on the journey with her. Her own background was in investing from day one, and it was really it really started resonating as we started thinking about what a new kind of a fund could look like, really, right? And for us, our unique ability was really in the sector experience we bring in. She brought the same experience in healthcare, the insights, the networks, and that is what we thought will be our unique advantage when we go to setting up our fund, because capital is really becoming a commodity. You needed to have your own value proposition, and what is that value proposition? Why should companies come to you? Why should investors give you money, right? So it became clearer to us that we wanted to build a sector specialized fund. So whenever we build a fund, it will have sectors that we know. We have another partner, Karuna Jain, who was actually colleague of Jayashree in her business school, and she'd also had 13 years of investing experience across asset classes, last 6 years with Acumen India in impact investing space. So the happy accident here was we all are three women, but it was not so much by design, but more by our sector focused design that we all got together. And we've really now started to own the story of the story, the power we bring as women investors also, but really just, this question keeps coming to us, right? Is it by design? Is it by choice that you have 3 women GPs, or is it, is it something that came together? And the true answer is we were looking for sector expertise and we all came together. So that's really the background of how I got into setting up the fund. Our fund is called Enzia Ventures. We focus on 3 sectors: healthcare, education, and we also added climate as the other focus area. The reason we added that was really, this is while education and healthcare, where we bring large, long experience of working in these sectors, climate is also one place where both Jayshree and Karuna had done work, in the solar and wind and energy space, but this is a space which is completely unraveling now, and there is no real expertise. But by focusing on this sector, we can be one of the people to build the expertise, um, uh, and be at the forefront of solving climate challenges through the investing work we do. And hence we decided to also add climate to the focus of our fund. Um, so with that background, maybe just from really thinking about what do the first 100 days look like. There are some key questions that we needed to answer. I've given you the background of team in terms of how we got together, but perhaps I can cover three things. One, a little bit more about why team matters and what kind of questions come up when you think about building a team, even from an investor's point of view. So that is the first part. The second piece we can cover is really the business model. Like, what is really the business model of a fund? How do you think about your key questions in terms of thinking about the fund business model and the choices you have? And the third is, of course, the fundraising part of the building a fund, right? And again, what considerations do you have? How do you go about fundraising? Um, so on the team part, I already gave you a brief in terms of how we got together, but I think this is also an important question for both you and your investors, the people who are going to give you money. Because if you really think about it, the biggest risk for a fund is really the team of GPs, the general partners, the partners, right? So it is the biggest risk that you are carrying. It is the biggest risk that your investors are carrying. And most of the time, investors are not ready to take the first time fund managers risk, right? Because they've not seen the fund managers working together. And the teams who have worked together in the past, maybe in a different outfit, and when they come out together, it's much easier for them to talk about their chemistry, their strength, and their ability to work together. And the risk mitigation is more visible. But if you are building a newly putting together the team from scratch, this question is going to come to you all the time. And I think this question is not just a question from the perspective of investors, but it's also an important question for yourself, right? Because how do you look to kind of carry out the fund responsibilities in case there is a conflict, and or how do you think about resolving conflicts within the team? So the founders team become very, very important. So the smart thing that my partners did was, actually before we launched the fund in late 2019, is both of them got together and started working together and started doing investing together. And this was without raising the fund, but really finding certain opportunities, building thesis in the health tech space, finding these startups, and then just syndicating the deals on angel list. It also, it started to give them a sense of how they work together. There was a joint track record also being created as they were investing in the companies. And by the way, the companies we invested in 2020 through this route are already at 3.5x, right? So now we also have a joint track record to talk about. But these were some of the ideas that we employed to kind of check for GP team sticking together, showing the joint track record to our potential investors. Even before, so this was between 2019 and April 2021 that Jayshree and Karuna were doing. And while I had decided to join them in October 2020, I only full-time joined them in April 2021. But between that, with those 6 months is what we really used to talk about our shared purpose, our value proposition, really all the things that founders need to talk about. So, really, what you will tell a portfolio company that they should do, you really need to kind of, get into the shoes of being entrepreneurs yourself and really talk about what is this founding team, right? What is your vision? Why are you together? What are your guiding principles? What will you do? What will you not do? How will you operate? So some of these things are very, very crucial before you kind of get into the thick of things and start doing things, right? Because it's such there's just so much of work once you get into it that just taking out time to reflect and trying to course correct is harder. But if you've already discussed and spoken about such things, you have a base to work off. And I know this may sound like a trivial thing to hear, but these are actually the things that most people kind of put on the back radar, and it will happen before these things are not spoken about, and you do not have that foundation to kind of go off. The other thing, the consideration you will have is, should you go solo, should you go in a team of 2, 3? It's your choice, really, right? I think for us, the 3 people team have also helped us to move fast, because we have different strengths. We have been able to leverage different strengths to make progress on different things and really work fast. For example, most of the time, fund managers will tell you that just focus the first 24 months on fundraising and then think about investing, because as a fund manager, you do not have the capacity to do both. But because we are a team of 3, we have been able to actually do some of these things simultaneously, right? So just one consideration as you think about teams. So the size of the team, what do you want to accomplish together, the founding team, chemistry, do you see yourself like being partners for next 10, 15, 20 years? What are some of the ground rules you want to set up upfront? And really, who do you want to partner with to mitigate risk from the perspective of have you worked together? Is there a joint track record? And if you've not, what do you really, how do you really mitigate those risks by doing something upfront before you even get into full fund format? So that's on team. Before I go to the second part, which is on the business model, I can also take a pause if there are burning questions. I know there are some questions floating around, especially on the parts so far I've spoken about. But as you know, I'm going to talk about the business model and fundraising in a bit.
I can check with the group. So shall we take a 1-minute pause for questions? Would that be okay, Namita?
Mm-hmm.
Awesome, fellows. So best would be, this is also a chance to sort of introduce yourself to Namita. Please feel free to ask your questions. It's so much better than typing it out. Any questions thus far?
I mean, I can go.
Sure, Visa. Go ahead.
Yeah. Namita, hi. You and I, we interacted, you remember, with Rama? Yes, over this deal that we were talking about. So I just wanted to kind of understand that how long did it take for you to raise the first 30% of the corpus, right? And how did you go about deciding the corpus, right? Because that is equally an important piece here while you're kind of defining towards the business model of the fund, right?
Yeah. And perhaps I was going to cover this, so maybe I can take it in the flow. And if it is not answered, Visa, we can revisit it.
Yeah, sure. I just thought I'll just kind of.
No, it's good. It's good to know that, the next, 10 minutes of monologue it must cover this question.
Yeah. Hi, good to see you again. Yeah. So cool. I mean, yeah, whenever.
Anyone else, please? Folks, please go ahead.
Yeah. Hi.
Go ahead.
Sorry. Yeah. Hi, Namita. My question is around how important is it to have sector expertise, before like starting a fund? Like, is it okay to be sector agnostic, or is there a preference to have one sector for one of the founder? Yeah.
No, that's a great question, Shivi. And I think more than sector expertise, I think really you need to have your own value proposition very clear, right? Why should you exist? There are lots of funds out there, right? There are lots of this capital floating around. Why should a company take money from you? Why should an investor give money to you, really, right? And the answer could be because I have this unique advantage of knowing the sector so well that I'll be making the best of the investments, and the best of the entrepreneurs will come to me because they will see the value that I bring to them, right? And hence I am relevant and I'm important. It could be I have this skill set to actually take companies from India to global markets, right? Uh, and that is the play I am working on, right? Or I can put together a network that can help my companies to do so. I may not have all the expertise today, but I may put together that, right? So really kind of it's really like the idea of playing to your potential, right? And also becoming the signal and separating yourself from the noise, right? So I think that is how you should see that question, that piece, right? And in fact, maybe that's a great segue to talk about our business model, right? So for us, this was actually a very important question, right? We saw that we already have the sector expertise, right? We have been doing this either in form of investing and operations, but in these sectors, and hence we will have a value proposition to bring to the entrepreneurs, and the entrepreneurs will see that value and come to us, and hence we'll be investing in best of the companies, thus creating the maximum value for our investors, right? So that was the first starting point for us. But believe me, that's also not sufficient, right? Like you have to still be even clearer about your value proposition. And in fact, one question that also used to come to us is, you're operating in these sectors, are you more of an impact fund, right? So we also needed to clarify that piece. So we always used to say we are sector first. But then when we put our heads together on the impact piece also, and by the way, I have worked in impact, Karuna has worked in impact, right? So, and we've really come from the, from the deep impact investing or the impact world. And where we landed was that for us, really what matters is that our companies should certainly create outcomes for their customers, right? Whether it is in education sector being learning outcomes, in healthcare sector it being patient outcomes, or in environment sector being really about the carbon emission outcomes, right? But the company should be able to demonstrate that, right? And while this is spoken about, in generally also, but that is to kind of even define it and then to be able to measure it is also not so easy. It is non-trivial task. So what we really say is that we as a fund focused on these three sectors also bring this value proposition of helping our companies take on the charge of defining the outcomes and measuring the outcomes, because not only it is useful for generating impact, but it's actually also important for generating financial returns. Because if you really think about it, the better your customer outcomes, the more customers you will get, the happier your customers are, the lifetime value of those customers will increase. They will also bring more customers to you, and hence your profitability is likely to go up, right? So by defining this outcomes value proposition, we were able to tackle the question of what are we going to do differently as sector specialists, plus how are you different from any other impact fund that you are. So I think, and again, this was something that we had to put our heads together, and actually in the first 100 days of our existence. And that's why I'm sharing this, because really even more sharply defining your value proposition is very, very important, right? I think Visa has a question, so I can pause.
Yeah, I mean, Namita, is just this on the same metrics that we just spoke right now, right? Because creating value and outcome, right? So in my understanding, and I would love to hear your viewpoint, right? That any business that has to kind of scale, right? There has to be some outcome based, right? Unless you're talking about pure revenue zero, capital growth, right? So why is it that anything when we are looking at these metrics come under impact rather than it should be more of a general proposition of any venture capital? Because that's something that I always struggle with. And you know why, right? I mean, that's where impact, I mean, I don't understand what's the definition of impact fund and not impact fund, because at the end of the day, you're looking for returns and you're looking for those. At the end of the day, what I learned from Ritu is customer love, right? So if there is no customer love, there is no value proposition, then business doesn't grow anywhere. So why is this something called impact fund and not so impact fund?
Yeah, I think, so you are spot on, Visa. I think, the way we articulate this internally and, to the external world is that this is what companies need to do anyways, whether they are impact companies or not. And maybe in our sectors, they need to do it even more, right? The customer love needs to be even more. I think my hypothesis is that the reason the impact funds or get these questions more is because of the source of capital you are raising, right? Like if you are raising the capital from the institutions who care about impact, they will ask you these questions and it becomes more imperative for you to answer these questions, right? And if you are raising the capital from purely commercial LPs, maybe they do not, by the way, but ESG is becoming very, very important across the board, and ESG itself is forcing the industry, overall industry, to kind of really think about certain, which I would call still like, the almost the basic building blocks of the right things to do. And I would not be surprised if the impact and the VC world will just collide, right? 20 years down the line, and there is no differentiation really.
Yeah, in my head, it's both the same, to be honest. So I just don't get it. But then I think something that is like a takeaway for me is from what you said is basically the LPs that you're kind of bringing onto the table. I think that is a differentiator here for me then, majorly.
And to be honest, Visa, there are also other kinds of impact funds, right? Which define their impact as really first targeting the bottom of the pyramid, right? So when you are defining your impact thesis like that, then you are definitely different from a pure commercial VC fund, right? So so at some place the impact and the commercial VCs kind of merge. Although one can argue that the mass market is also in the bottom of the pyramid. So if you're not reaching them, you're also not doing a full service. But businesses are being built just catering to the first 100 million population of the country, right? So I think the thing with the impact piece is that it is no one definition, right? And you are choosing your own definition. In our definition, and it seems like in your definition, the impact and the finance kind of financial returns go together hand in hand. Yeah. Bhanu, did you want to share something or?
Yeah, I just have a quick point to what Visa has asked, and I will pile on a little bit and try to dig deeper into your experience, Namita. One of the aspects which I fundamentally see as a difference between impact investors or LPs who are more leaning that way towards more market-oriented LPs is the fact that there's a whole discovery process in impact investing because the solutions are not pre-ready, right? The entrepreneur and his team or her team have to go and try 7-8 things before they can even put their finger on what works, right? So you have been on the side and managed impact investments, right? I would like you to kind of elaborate a little bit more on that attribute of the fund and the LPs, which is slightly the permission to fail on few things in the interest of trying to figure out the right thing which will work.
Yeah, and really this idea of patient capital really there, right? So having a longer runway to the fund life, right? So typically a fund life will be 7, 8, 9 years, which means you have to deploy capital, you have to return capital in that time frame. But sometimes some of the deep impact work that you do, and by the way, it can be again, like not going to the definition of impact, but really some things require more time to incubate, to gestate before they are even ready for growth, right? And I'll take some contrary examples, right? Like the deep tech work that you do, like the devices that you build for hospitals, right? It will require a lot more time from from product innovation perspective itself. Look at Breakthrough Energy, right, which is Bill Gates' energy large fund, right? The fund life there is like 20 years, right? Because we are really talking about investing in technological solutions which will solve the climate issues, right? So here it's really that patient capital that is driving the fund life, fund thesis, in terms of saying, okay, this cannot be done in the business as usual manner, and we understand it, and the capital here we are providing is for a longer lifetime, right? And in fact, more and more I hear of the LPs, European LPs, being very patient about the longer life of the fund, right? But in India, the domestic capital still, like, we've now gotten to a place where the domestic capital is more available for VC, and the 7 to 9 year time frame is what we work with. So I don't know if it fully answers your question, Bhanu, but yeah.
No, I think that's a fairly good elaboration. Yeah, because I see that as one of the very, very differentiating attribute, particularly of LPs, particularly if you're sourcing for that kind of ventures.
Yeah. And I think really the point you are bringing home is choose your investors, right? Because you do not want to also be working with investors where the expectations are not aligned, right? So depending on who you are, you go and find your investors as well, right? So just maybe a couple of things on business model, and before we go into fundraising is, so yeah, we are a sector focused fund. We've chosen to be thesis driven. What that means is that within education, health, climate, we will say, okay, what are the subspaces that are very interesting? And within those subspaces, do we have an early view on what business models we want to back, right? So what that helps us with is we do all this groundwork so that we have a point of view before companies come to us, and we're able to move quickly. But also, as we develop this knowledge, we are also able to put it outside. And once we put it outside, the networks really start working, and we are able to see deals much early on, right? So almost like a brand building and sourcing exercise, and sourcing is a very important part of what you do as investors, what you do as fund managers, and really having that differentiated sourcing muscle is also very important, because ultimately that is your product here. Your capital is the raw material, but you're really putting it into the companies, and you want to be able to source the best of the companies. So for us, it is being about thesis driven. The other important question really is, how do you allocate the capital that you raise, right? And we'll come to the fund size questions, but how do you allocate the capital that you raise? And that's really a big choice that you have to make, right? So you can raise the same capital and choose to invest in 60 companies, but only at the seed stage. Or you can choose to invest in, say, 30, 35 companies, but actually at least do one follow-on round with them. Or you could say, okay, I'll only invest in 15, 20 companies, but I want to be able to also deploy capital at a Series B stage when I have more proof points, and when I have enough data to double down on the winning companies for me. And how do you really answer these questions? So the first question you really need to ask is, who are you? What is your role? What is your capability, right? Do you have the capability to evaluate companies, from seed to, say, Series B stage? And again, I'm just taking this as an example. You may very well choose to only invest in Series B companies or Series A or Series B companies, right? Not even look at seed stage companies, but just going by my example. First of all, really just ask the question about the role and the capabilities you have. The second is the role you want to play, right? How much time do you see yourself spending with the companies, right? So if you have a portfolio of 60 companies, and if you want to really work with each one of them, it's very, very hard, right? So should you rather spend more of your time with the smaller number of companies, but then become very selective about who you are choosing, right? Because there is always a risk return ratio that is attached with how many companies will fail and how many companies will really progress. So you have to do that entire math of what is really your portfolio construction, and because ultimately you are in the business of capital allocation, and you need to get that right. So I don't know if I was clear, but really I think one key question that you will need to answer in the first 100 days of your fund is, how are you going to allocate capital that you raise? And there are going to be so many choices that you have, but the answer will come from, who do you want to be? What is your capability today? How do you divide your time between the companies and in supporting them? And within who are you, right? Like, what is the message? What is the brand that you're building for yourself, right? Are you a early stage seed fund, or are you a fund which also does follow on investment, right? And by the way, the follow on investors typically get a little bit more preference from entrepreneurs because they know that this is not the first time funding I'm getting from them, but this investor also has the capability to put money again in the business, right? So no clear answer, but you need to answer this question in the first 100 days. So maybe with that, we can get to the fundraising and the size of fund question, unless there is question on this part so far.
Let me just pause for a second and ask the fellows. Fellows, anything on what Namita covered? I feel that the math aspect of it is really important. And if somebody has a question, now would be the time.
Namita, I just wanted to ask, when you chose impact as a thesis and chosen the healthcare, education, and sustainability as aspects, you excluded the financial inclusion or the financial services part of it. Was it a conscious choice? Because that is probably one of the biggest impact creators, right? When you are providing access to capital. Is it because the team, you thought you lacked the expertise, or you didn't want to touch it because it's already overcrowded?
So actually a combination of both. So the deeper experience, so my partners bring the experience in investing in financial services also, but not as much, right? The kind of experience we bring in health, education, and even the energy and the climate space, the one a decade ago, right? Plus that this is a space where there's a lot more expertise just even with the investors, or like a lot of people are entering, the entrepreneurs are entering into, setting up their own fund. So those were the choices we made, right? And again, being focused has been one of our principles. So just, keeping it focused to what we know, really. Great. So, and, I just want to clarify that the impact thesis for us, like we didn't start from saying we want to build an impact fund, right? We really started from saying we want to build a fund that helps to solve problems in education, healthcare, and climate. And these sectors by themselves seem to create impact on, as their fundamental needs of humanity. And the way we define impact is really about the outcomes and no other way, right? So we almost defined our own definition of impact before saying that we are an impact fund, right? So, yeah.
No, just to give you the context, I had the fortune of meeting Karuna and Jayashree in my earlier role. Okay. I was on the other side of table. I was at SIDBI, and they were trying to put in the application. I don't know how far this fundraising has been so far. But yeah, the other thing which I'm keen to learn, you guys have been on this journey for 2 years. Now I am on the similar path like you guys have already started. So how long has it taken you to reach, have you already announced the final close? And especially since you are a women-only fund, I mean, all the GPs are 3 women. Many of the DFIs do want to promote and all, they say, yes, we will come forward. But finally, when it comes to writing the check, there are not many takers. And I'm sure you'll resonate some of those thoughts. Was it challenging because it was a woman-only fund? Were there pluses, minuses, your thoughts on it?
Yeah. So I think it's a good segue to the fundraising part itself, and hopefully I'll answer all of these questions. But just to clarify, so the journey that Jayashree and Karuna took between 2019 and April 2021 was not on the fund per se. They were investing in individual companies through angel syndicate. So we'd not actually applied even for a fund or launched the fund, right? So the fundraising had not begun until like August of 2021 for us, for the fund that we've launched now. So we applied for our registration, and our registration came in August, and that's when we started working on the $40 million fund with a green shoe option of $20 million. And maybe, really talking about, how did we even arrive at this size of the fund? Again, simple questions, first principle questions really, right? How much can we raise? How much can we deploy? And I think a very important question is how much, at what size of fund can you show 4 to 5x return really, right? Because, and what is the math behind that, right? So if I'm raising 1,000 crore fund, I have to return 5,000 crore, right? And what is the possibility of, what in my portfolio construction allows me to, return 5,000 crore of capital, right? So I think those questions really, those three questions really helped us to hone in and say, let's do a $40 million fund with an option to raise another $20 million fund, because we are investing early on. It checks in terms of check sizes and the stakes we are taking, and we are very confident of returning that 4-5x or more actually to, the capital back to the investors, because really the success I have with first fund will determine what I'm able to do subsequently in fund 2 and fund 3, right? So I think the size of fund, there is no fixed mantra. I have known people who have started by saying, I want to raise X amount, and they have been at X multiplied by 2 or 2x, or people who have started by X and saying, this is half of the X and I'm happy with half of the X that I have raised, right? But you have your, I think, again, that's why the point on the capital allocation and portfolio construction was very, very important, right? So you should know, if I'm raising $40 million fund, how will I deploy? If I end with $30 million, what will I do? The other reason we are targeting $40 million is, while we say we want to invest in 15-20 companies, because we do our current portfolio construction, we want to be able to deploy capital in late stages of companies in our winner companies. So I need that extra buffer of money, even if when I'm building a portfolio of 15-20 companies, to be able to deploy that, right? So, I mean, I could just do with $20 million and invest in 20 companies also. Before I kind of, talk a little bit about the principles of fundraising, but just to answer, where are we on fundraising ourselves? We are, I would say, 2/3 of our way in terms of capital raise. We are still to complete the 1/3 or so for our capital raise. But it's a long process, even in terms of, from, of course, making pitches to people but just completely getting them on board is a long time, and it requires a lot of patience and a lot of follow-ups and everything. So so while we are expecting our fundraise to close by September of this year, we have time, from based on our papers, time till even September of next year for that matter. But we will hopefully close the fund by end of this year, if not before. We can talk about SIDBI separately, but the process there is on. So, some things maybe I can touch upon when it comes to fundraising. One thing I've already touched upon, right? Like, so the investors will ask you for your joint track record, right? And you, of course, your individual track record as investors, but also as a joint track record as investors. And we solved for that, when Jayshree and Karuna did those angel syndicate, and we are able to show what those companies have been able to raise capital in the follow-on round. We also solved for it in another, we are also solving for it in another way, which is essentially because we are 3 partners, we started looking for companies and deploying capital as we were raising capital. And we've already invested or completing investment in 5 companies, right? So I have had investments, since September, and some of those companies will start raising capital now. And hence, those become an interesting proof point for institutional investors or even family office investors to really say, okay, what are these guys able to do from a business point of view and not just fundraising point of view. So I think, so you have to figure out your own innovative ways of showing the team track record, right? Not just the individual track record. And this is what we have been able to do what we have done, and hopefully we are able to convince some with that. We are not able to convince everyone with that. And that is part and parcel of how fundraising works, right? And it is true that, you reach out to 100 people and initially 2 people will say yes to you, and you should be all comfortable to hearing no. And one mantra, I think we realized that, we should just think of a no as a not yet, because maybe this investor will not come today, but, this person or investor will, or institution is still important for me in the institution I am building, right? So don't take it to your heart, be resilient, keep them always in your database, send them your newsletter, keep them always updated, because at some point that investor will be important for you. The other thing you will hear is, do you have an anchor investor, right? And we did not have an anchor investor. Typically, an anchor investor is who will put in the first check and say, here is the 10% of your fund, and you can use this to raise more capital. Even institutions like SIDBI today, say, I will actually come in the end, right? While the capital contribution could be more than 10% of your fund, but they will not be the first one to come in. So, and this is a choice you have. Actually, you can go and find an anchor, and sometimes you can go and find an anchor by shelling some part of your GP stake with them, right? So if people believe in you, and they're willing to write a large checks, you will get those offers where they will say, you take 25% of your fund, but give me 25% of your GP stake in the fund itself, right? And again, that's a choice you have. We decided to not go through that route because we're already 3 partners and we are a strong team. We do not feel the need to necessarily use this as a way to raise capital. We are able to raise capital. Of course, it's not an easy road. Nothing is easy. But we have chosen to not go down that route. I'll come to the placement agent bit in a bit. But before that, the way we flipped the problem around and we said, and lots of people do it, right? We said, okay, let's go to people who will give us the first 10-20% of our fund, right? And the answer was really the individuals we have worked with. So we went to many individuals and we said, okay, this is who we are, this is what we are building, would you invest in us? And a lot of people backed us, right? So that essentially was the first round of capital that we raised, right? It was a little over 15% of the capital we raised, and that helped us to go to the people who are in our second degrees, the family offices and the institutions, to go to them and say, hey, would you like to invest in us now? We do not have an anchor, but this is really our capital, which has come to us because of the credibility that we have in this space, right? And I see this is not unique to us, right? But it's something that when you go to a lot of seasoned fund managers, a lot of times the advice will be to go find an anchor, right? But really, I think you can also think about that, you do not need to solve for an anchor just by thinking of an anchor as an institution or someone who will give you large check, right? One person who will give you large check. The other choice people have is to also hire placement agents who help you to raise capital. But I have to tell you, we have not worked with placement agent as yet. Again, because we didn't feel the need to do it, and also lots of economics share with them. So we take an economic decision in terms of whether you want to go with a placement agent or not, and it really depends on your own capability, your own networks, and your ability to mine your networks, whether you go down that route or not. We may choose to work with a placement agent down the line, but towards the last leg of our fundraise, but maybe not. We don't know. So those things. Let me just see if I have missed anything on fundraising. No, that was really what I had. I'm sure there are more questions that you have. Somebody asked, how long did it take you to raise first 30% of your capital? So we raised the capital in 4 months, but to complete the paperwork, it takes like 7 months, right? So So, the answer is anywhere between 4 and 7 months. But now we are talking to a bunch of institutions. So again, the time will be longer, but we actually started to talk to the institution. We didn't wait to start talking to the institutions till we raised capital. We went to them and said, this is who we are. We just want you to know us. We know that, we need to prove a few things before you can take us seriously, but, keep us in your mind, right? And when the time comes, then, they will, you can have deeper interactions with them.
Awesome.
Yeah.
Thank you, Namita. This would be the section where a lot of you might have questions, so feel free to ask.
Can I? May I?
Yeah, please.
No one has any. No, if no one has, because I can kind of shoot to Namita's, I'm connected with her, so that I'll just let others kind of, take the pie, and if she has time, then I can ask.
You can just ask, you don't need to worry so much.
And
Okay,
Namita,
fine,
other
great.
thing which I was keen on knowing is, how big is your team now? I see that you already invested in on the website. There were some 8 companies which are listed as portfolio. So when you showcase it to the investors, it's chicken and egg, right? They're like, where is your team? And you don't want to incur the lot of cost before you get the first close or that larger checks in your account. So is it just 3 of you running the show, doing everything end to end, or you have expanded the team?
Though if you had asked me what could I have done better is, hire the team sooner. But now we have rolled out 1 offer. We have 3 more candidates, of which we will finally make up, our decision next week. So we'll have 2 analysts or actually analyst associates joining us in July. We've had 1 person helping us with our, lots of the back-end support work. So the team we are envisaging is, 3 of us, 3 them, plus 1 finance person. And we should have hired earlier. But it is a chicken and egg problem, because you want to get to a place where you can actually tell your team confidently that, this is how large we are, and, this is the career path we can give you. So it is a chicken and egg problem, but we do hope to have a full stable team, by July. And of those 8 investments, the 5 are the angel syndicate investments, 3 are the fund investments, and there are 2 more fund investments that are currently being signed.
Okay.
Can I go next?
Yeah, please, yeah, go ahead.
Hi, Namita. So this is more towards the capital allocation in the context of how do you sort of look at the sector? Because when we think of education, it's so vast, and say with new sort of technologies coming in, it is also quickly evolving. So like you mentioned, one of the ways to think about it is really understand what my capability is, and what I can bring to the table. But something so dynamic, right? It's sort of like a problem of plenty, right? You want to probably stay on top of the game, invest in whatever really hot sort of sub sectors and so on and so forth. So how do you really bring about that balance, or how do you approach thinking about it?
It is a constant battle to find that balance, to really say, okay, this is the capital we are raising. This is the capital I have in the, signed, right? So how many companies can I, before you close your fund, right? How many companies can I even invest in, can even commit to before I have closed the total amount of capital that I envisage to raise. Besides that, no, I think you need to be clearer about within a sector, what will you not do, right? Or will you invest in multiple companies in the same subspace, right? And when you are building the thesis, right, what has already been invested a lot, right? So I think some of those things will help you to say, yeah, the sector is large, but again, depending on your portfolio allocation, right? If you choose to do only 1-stage deals, seed stage deals, build a portfolio of 60 companies. You may choose to invest in 20 companies in one of your 3 sectors, right? But we have chosen to invest in 15 to 20 companies. For me, actually it makes my life easier because I can say no to a lot of things, right? Because it's not meeting my bar. So you kind of create your own bar. And we have invested in 3 edtech companies so far from the fund. And I am really saying, okay, I don't need to rush anymore in edtech space, right? I need to really find the 4th one, and so every company you invest in, the bar gets higher for the next company you invest in. And also, I think an important part is, again, depends on all your risk appetite, right? Like, you within a sector, always keep looking at the portfolio. Is the portfolio diversified enough, right? Should you have all the companies which do not have monetization model, or if you've invested in one company, you're okay with not having a monetization model up front, but the next company you invest in, when do you need to see that monetization model, right? So you need to kind of always keep looking at this, the portfolio, that diversification and everything, right? I hope that answered your question.
Yeah, that has helped. Yes.
Awesome. Any other questions on this segment?
I'll just ask one. Namita, I was trying to understand is that how important it is, right? Or how difficult it is, both / right, to bring an institutional investor on board rather than going individual?
See, it is difficult because the institutional investor have access to all the funds, right? So they have so many choices to make from. The institutional investors are also not the fastest ones to move. They have a longer checklist of things that they are looking for, and especially if they have an impact criteria, they are also looking for those. They're also, when they are thinking of their annual plans, they have their own strategies at that point in time. I want to invest in Southeast Asia fund, and Indian funds do not matter to me, right? I want to invest in gender balanced teams, right? I want to invest in funds which are, I've already invested in XYZ sector focused funds, and I now want to invest in this, right? So there are a lot of criteria that they are working with. And the reason I'm sharing all of this is, to be able to empathize with the institutional investor themselves, right? Why is it difficult to, for them? But it's really like when they come, they'll give you a larger check, right? And for us, so that is one. And the second is, they become, if you do a good job, they will probably also have the capability to do follow on in your fund 2 and fund 3, right? So you do want them. So and hence it is important. That's why it's important. They also, we haven't started working with an institutional investor, but there's also a lot of exchange of knowledge, right? Because they've been working with funds, and hopefully, some of the wisdom comes to you as a result also. So it is important. It is a different kind of investor, so you need to kind of work with them differently.
And how do you marry different kind of investors coming on board?
So we have to still figure that fully out, because we're still onboarding different kinds of investors. But I think it's also important to have the expectations aligned, right? I do not want to have investors where the expectations are way off than who I am, right? So once the expectations are aligned, even when, the impact institutional investor, right? I share my impact thesis, right? If it works with the institutional investor, they will invest in me, right? And they will invest in me for the business model that I am creating, for the impact model that I am creating, right? So once that is there, I think the base of the work is done. And then I think the rest of it is, you may need to have dedicated person to do things, in terms of investor relationships or LP engagement. The good thing is, again, like because of the strength of our team, a lot of these things we can manage on our own, but of course that means we need to hire for other things in our fund.
Awesome. I have a question. Is it okay if I ask?
Yeah, please. It's all yours.
We are out of time. So sorry.
I asked Namita, she can take 1 or 2 minutes extra.
it's a more elementary question, and you may have already answered it. I'm sorry I joined it. I had to come in from the meeting, but I've a lot of the way you're talking about it is also that so much of the first fund creates the space for your second one, and how the performance of one helps in the second one. But as like if the deployment window is long and you have another thesis or a sub thesis for which you want to raise your second fund, what would you mean that performance would be then? Like, how do you measure that performance without money being returned? Like, what is the measure of that? How do you?
Yeah, and I think this is a great question, and the answer is the market will tell you, right? Like, matlab, if there is, the potential investors of fund two will tell you what they are looking for, but most of the times people are also able to say, of course, I'll not exit my companies, right? Because it probably does not even make financial sense to exit my companies before I raise my fund two. But can I show the up rounds in them? Can I show the operational metrics growing in them, right? Can I show that the follow-on investors are valuing the pipeline, my portfolio, right? So almost like a validation from the market in terms of that the portfolio is doing well. Will become important, right? That is bare minimum, and if you can get an exit, that's great. But I think it is a hard one to crack, to get an exit.
Absolutely. So then, okay, I heard you say up rounds, just a general impact report of what each portfolio is doing. And how do you manage being a smaller team, especially as a first-time fund investor? You'll be 3-4 people, maybe an analyst or maybe an associate there. This will require kind of like a very skin in the game kind of investment with the portfolio. So how do you manage that being like a very small team? Because it will be important.
So that is why we've chosen to only build a portfolio of 15-20 companies, right? Because now which means that between the three of us individually, we are managing 5-6 companies, right? And it is still easy. And again, this is a strategic thing. It's not that, there are funds like Better Capital, right? Who's solo fund manager investing in 100 companies, just that the model, I don't know what Weber's model exactly is, but I'm assuming his model is that he's not spending as much time with the companies. He's just basically making his capital work and helping them where needed, right? So you have to, really, it's about both resource and bandwidth allocation question there.
Awesome. Great. Thank you so much, Namita. Just before you go, our fellows, their graduating assignment is presenting a fund thesis. And today, a lot of your mental models and pointers will be super helpful to them. Any parting advice on how our fellows should present? Because that's the evaluation criteria for graduation for everybody.
Wow. No, I think, I think expecting to answer all of these questions is tough. I don't know when you are graduating, but even if you maybe, focus on your value proposition, business model, portfolio construction, that part of the strategy, because that almost is the building block of your pitch, right? When you go and raise capital also. And perhaps determining the size of the fund, answer to the size of the fund question. So focusing on those parts. And if you have, as you learn, and if you can also answer the question on fundraising and the team you will build, especially the founding team, I think it will be helpful. And if you have already a team member or your GP partner, then I would say definitely take a crack on really what will make the partnership work, right? And where can it, fail, and what can you do to address them proactively? Again, not easy questions to answer. It takes a lot of time, but I will answer those in that order.
Well, thanks so much, Namita. And just like some parting questions for me, only if you have a minute, answer them. Otherwise, I'll chat with you privately. Of all the things you could be doing right now, you could be building a company, working at a company, setting up a company, why allocate capital at all? Why do this? Like, why, how does this change the world in your lens?
It helps me to solve many problems at the same time.
Got it. Perfect. How do you avoid groupthink? All the VCs tend to tweet about the same things, write about the same things, get excited by the same things. How do you avoid that?
Build your thesis up front and have your own conviction. I think the harder thing will be, when your portfolio goes on to raise capital, not having the conviction to back them unless there is an external validation. So that's a very, very hard thing to do. Very, very hard thing to, overcome. But, we are talking about it internally in terms of what does it mean for us, right? So I think just being aware of it and, thinking through it upfront and hopefully doing the right thing. We don't know where we will land, but hopefully doing the right thing.
Final one. During the 10, 12, 15 hours you work, what's the one part of your day you enjoy the most, and what's the one part of your day you enjoy the least work-wise?
I definitely know what I enjoy the most. I really enjoy my work with my portfolio. So I really enjoy that part because, that's where the creative part of my brain really is, and the product manager in me really starts really thinking about problem and, the ways to think about things and helping them, navigate the questions that they are thinking, from our vantage point. What do I enjoy the least? Yeah, something that we did not touch upon, but the reality of the fund management business is you're not just an investor anymore. You are a fund manager, which means there's a ton of compliance work that comes your way. And you have to, take care of all those compliance work. And there's a lot of unknown, right? Because when you're doing it for the first time, you do not even know how to handle everything, right? So so the compliance part is tough, but we are building that muscle and hopefully doing the right things. We also end up outsourcing, to the right service providers where we do not have the right expertise in-house.
Hey, Namita, thanks so much for taking more than an hour out for us, and we definitely look forward to having you back soon and sending you lots of deals and interesting people that you can perhaps look at.
Please do, and wish all of you a great success in whatever you choose to do in terms of your own fund manager journey, and whenever you do it. I am around. I'm on LinkedIn. I'm on email. Happy to chat, specific questions or just bouncing off something. So thank you for having me here. It's my pleasure.